welcome to the course. Yesterday I was telling you about what is the basic of engineering economy and what are the main things that we are going to cover in this particular course. And we ended up the class where we were just evaluating, at least in my personal opinion, why it is important for engineers to understand the economics and the money matters. And one of the examples that I shared with you was about this Challenger, the final flight, right? Have any one of you seen this documentary? I think my safety students, I would have recommended this, right? Did I not? Did not see? Next time I should ask questions on this then. Okay, so here is just a very basic overview of what all steps are involved in a typical engineering economic analysis. And our whole semester is basically centered around these 7 steps. There is nothing rocket science in this particular course in that matter. The concepts are very simple. The variations are what makes it complicated, but the basics are pretty simple and pretty neat. So the idea is that you start with a problem that, okay, this is something that you want to solve. For that, you try to identify what are the available technologies or solutions that can help you solve a particular problem, right? So that's your step number 1. Then you generate a lot of data. Data, since you are interested in the economic side of it or the financial side of it, you generate a lot of cost parameters about each and every solution that you want to evaluate. So the cost could be, typically it is the initial cost that you require or any maintenance related cost that you need and things like that. So these 2 steps are most complicated steps in any real projects. In most of the problems that we will be solving in the class, these data sets and the problem will be given to you. But in your project, you have to develop these cost numbers also, right? So that's what makes it a little bit complicated. I will give you the analysis part, but in the real project, that data itself is not available and you need to estimate the data using various sources and methods. And that's what makes this analysis a little bit more complicated and interesting also. But yeah, for classroom purpose, learning wise, I will not force you to find data about, we do not have time. We'll be focusing more on the analysis during the class, right? So once you have gotten the basic data, we develop something called cash flows. We will come to that term later, but the idea of cash flows is cash transactions happening over the period of time. So you have a timeline and you just plot what is the volume of transaction, what is the money flowing in or out of a particular system or a bank account you can imagine over the period of time. And that is very essential information. If you got your cash flows wrong, there is no way you will get your analysis right. And even if after getting your cash flow wrong, if you are getting your analysis right, we need to talk about it, right? There is something wrong in your analysis then. Cash flow is essential and that's where most of your mistakes will also happen. That's where the variation will happen. How do you interpret the real world information in form of a cash flow is the most trickiest of, it's essential, simple, but it's the most trickiest of the information interpretation also, right? Then you decide, okay, when are you interested in evaluating the alternatives? Are you interested in comparing the performance today, 5 years from now, 10 years from now, and things like that? And there are multiple types of analysis you can do. Just pure money, a lot of people talk about something like in investment terms, we have a common term called how much is the return, like how much percentage return you are getting. So a lot of people are interested in that number. Some people work on absolute values. For example, out of 100 rupees, if you're getting 200 rupee profit, the margins are like 200%. So for them, the 200% is more important than the actual amount of profit that you're generating, which is still just 200 rupees, let's say, right? So depending upon what your needs as an investors are, you actually set up which criteria you want to evaluate the alternatives on, right? Then you do the engineering economic analysis. This is where most of our first part of the course will be focused in. And in that, you can actually have little bit of a complexity in terms of the uncertainty associated. Uncertainty is essentially coming because there is no way, this is not a perfect world, so you will never always, you will in a situation where you do not have perfect estimates about your cash flows. For example, there will always be a probability associated that you might turn into a profit if so much so losses happens or so much so risk factors come. So how do you account into that? That comes into this consideration, and based on that you try to identify the alternative, implement, check if it is really working. Over the time the alternative will also change, the problem will also change, and therefore you need to do the analysis again, right? So this is the basic overview. We are going to follow more or less these steps in every part. So it's always good to refer to this if you feel lost and where exactly we are in the whole spectrum of the analysis right now. Okay. So today I'll start with some very basic introductory concepts which are essential to learn this subject, and first is time value of money. Anyone here familiar with the concept time value of money? Time value of money, the concept is that $100 today is not same as $100 tomorrow, or not same as $100 day after tomorrow. Essentially, as the time progresses, the value of the money changes. Why? What are the factors that contribute to changing the value? Inflation. What else? Opportunity cost. Who said the opportunity cost? What is opportunity cost? If how does that affect the you got the opportunity cost definition, right? That if you are investing in some alternative, you are losing the opportunity to invest in another, and whatever the benefits that you have gotten there, it's the concept. But how does it affect the time value of money? It's an important term, we will come to that, but it does not directly affect the time value of money. Over a portfolio, it affects. When you are trying to consider multiple alternatives simultaneously you are investing money, it affects. But not in a single project, it's not considered. But we'll come to that later. Money changes its form because of many factors. You are only worried about what is the impact on your project. You are not worried about the whole economic situation of the world. You are not considering everything that you can't control. You are only worried about how does all these factors affect the money that you have set out for the particular alternative that you are considering, right? So yes, in your project, it still might affect in the same way, because your net money you might lose actually, because sometimes you will not be able to find people to get the job done, so that you might have to spend more resources to get the same job done, and therefore the value of your money in the project goes down. So depression can also negatively affect your project. Similarly, inflation, if inflation occurs in your project, your raw material that you want to buy will be much more expensive compared to what you could have gotten for a cheaper price. So that also negatively affects the kind of money you have in your project, right? Anything else? I was hoping for a very simple answer. Resource deployment, not simple answer. Have basic interest rate kind of a concept. I think all of you are familiar. When you do investment in a bank, simple saving account, you get like 4%, 2%. Now no longer even 2% you get, but essentially the same concept, right? When you are actually just keeping your money, bank is every year giving you some sort of an interest rate. So the same 100 rupees today has become 102 rupees tomorrow. So the money rate has increased, the value of that money has increased. Of course, whether it has increased in proportion to inflation or not is something that we need to consider, but essentially the investment generates, increases or appraises the value of your money, right? So those are the kind of factors. In short term, doesn't make sense. 100 rupee today is not going to be 200 rupee tomorrow. Only happens in movies, not in real world. But over the long period of time, typically when you're talking about construction projects, 5 years, 10 years, sometimes even 30 years projects that we need to evaluate, this same amount, small money gets accumulated and has a huge impact on the net returns or the net expectations of the particular project, right? So that's where this particular method becomes useful. Again, you have to take a call whether it is worth to go into so deep to do the analysis, or if you are dealing with very short time spans, perhaps you don't need to do such complicated analysis, just get some basic numbers done and you can still make a reasonable estimate about your decisions, right? So some of the things that many factors can affect the overall inflation or the value of money. One of the factors that I have given here is, this is about the fuel price. How does fuel price affect your value of money? Any idea? Yeah, so in terms of logistics and transportation, the cost increases. Correspondingly, every raw material gets more and more expensive. So basically, if you have 100 rupees today and the petrol rate was some X amount, you will not be able to buy the same amount of material tomorrow if the petrol money rises by 2x, right? And of course, different goods, different type of raw materials have different effect of this particular, depending upon what is their relative transportation cost contribution, but also affects. So just another factor that I just wanted to tell, right? So, okay, any questions about this? You are basically clear about what time value of money concept is, that $100 today is not $100 tomorrow. It could go up, down. How is what we are going to study in detail. Okay so far? All right. Again, we will be using this concept of interest rate a lot in this particular course. The meaning of interest rate will keep on changing depending upon the problems that you are solving. We are using interest rate as a calculation method. Later, you replace that interest rate with some other rate depending upon what your analysis wants to consider. But the mathematics remains the same. So, we are going to use the concept of this basic interest rate, that when you give somebody money, you expect some return in when the person is trying to return the money. So, you have invested, so you are expecting some percentage accumulation of money over the years, right? So, that is the amount of interest. It is the amount paid in lieu of the money borrowed, right? Because an interest paid is when a person borrows money and pays a larger amount of money over time. If you borrow 100 rupees today, if interest rate is positive, you are expected to deliver, let's say, 110 rupees tomorrow, right? Interest earned for an investor is the same difference that you have additionally gotten based on the original money. It's called the interest earned. Is interest rate always positive? Any examples where interest rates have been negative? It has been negative in Switzerland. Why? So, this interest rate, again, the concept we are borrowing from banking sector, right? So, banking provides one of the main essential roles banking provides is for you to deposit your savings, right? And savings is something that you can immediately access. It's not a money that you have invested for long term. Saving is something that it's very tangible. You can always go to the bank and withdraw whatever money is in your account, right? So, in India, you still, like when I started my job, 2013, the first job, it was about 6% interest rate. Today we have about 2.3, 2.4% interest rate. So the interest rates are coming down even in India. It happens as the country grows stronger, more economically in terms of whenever the GDP increases, there is a negative relation with the interest rate that comes part of it. In Japan, when I was a student, the luxury of being a student was that I was given an account at 0% interest rate, not a negative interest rate. Otherwise, they would have charged me money to keep the money in the bank. And this is also related to the government policy, because they want people not to keep their money stacked in the bank account, but actually invest in the economy. Because when you are investing, the new companies can borrow capital, they can start new businesses, new jobs can be created, and so on and so forth. Storing money in a bank account does not add too much value to the economy. It's good for you in case of emergency, contingency, you can withdraw, but country cannot invest that money in the long term, right? So that's why there's always a relative balance between which governments try to regulate, particularly in India. The Reserve Bank of India tries to regulate how much interest rate banks should be given, so that they can control how much money is going into the investment side versus the saving side. So yes, in many developed countries, the interest rates could even be negative. And therefore, if you're just keeping your money stacked, it is losing value, right? What happens to gold? India is famous for gold, storing the gold in lockers. What happens to that? Does gold also depreciates? Why not? Why does a currency note depreciate but the gold does not? Yeah. So this is again, this course is not about that. I'm giving you a very basic idea of some concepts that you will read about here and there. So there's something called fungibility of the money, and fungible resources are there's something also called a fiat currency. So all currencies in the world are more or less fiat currency. Originally, when rupees started, dollars started, the $1 that a bank could print has to be accommodated or supported by $1 equivalent of gold, actual physical gold stored in a vault somewhere. But gradually, nobody could keep up with this. Of course, the gold is a scarce resource. You cannot keep on mining it. So now almost every money in the world, even dollar for now, is a fiat money. It means that there are, for example, if there are $5 trillion in the market in the whole world, there's not equivalent amount of gold stored by US in their vaults. So there's no guarantee that the money will still have the same value. Therefore, the physical gold does not loses the money, because it's always a scarce resource. You will always find buyers who are willing to pay that extra money to you. But the actual currency note can always lose money. So let me move on to the course. I get distracted a little bit. But this interest rate concept, which is the amount of interest earned as a percentage of the principal. Principal is the original amount that you either lent or borrowed. So percentage of that amount is called the interest rate. And this rate concept we will be using very, very commonly in this particular course, right? And this has to be per unit time. For example, 5% per year, right? 5% per 6 months. You can define that, and these 5% per year is not same as 5% per 6 months, right? It is different, and we will also look at those kind of examples. This formula, has anyone in the class not read this formula before? Simple interest, class 6, 7th, don't know when does it get started, but some of these conventions are important. So in this particular course, we will always refer the principal amount, which is the original amount borrowed, by a capital letter P. The interest rate will be denoted by the small I. N is the number of periods for which the money has been invested. Capital I becomes the interest amount that you obtain, right? It's not the total amount that you obtain after, it's just the interest amount that you obtain, right? So in a simple interest, where anyone knows what simple interest is? Only the principal is generating more returns. And what is compound interest? So the interest is also generating more interest, right? So that's the fundamental difference. Mathematics of it is also pretty simple, but that's it. This course is about that. That's the only equation we are going to use, just changing it in different form. So still you have add drop weekend. This is only one equation you are going to learn in this course. You can drop if you are not intellectually stimulated by this particular course, okay? So this formula is pretty simple. The capital I is equals to the capital P I into N. So that this is the interest rate formula. Again, you readjust the I is equals to small I becomes the principal interest accrued, which is the capital I divided by P, and per unit time that now divided by N will also come into the formula, right? Simple example to prove that this function works or whatever that you have understood. Very simple example. Individual A agrees to loan individual B 1,000 rupees for a period of 3 years. B agrees to pay A the $1,000 at the end of 3 years plus an amount of interest determined by applying a simple interest rate of 10% per year. The total interest charge will be the capital I is equals to 1,000 into 0.10, which is the 10% per year rate I took, and the 3 is the number of years. You have to note down the unit of period is exactly equal to the unit at which the interest rate is defined, right? Very important concept. Again, more importantly, what I want you to understand is these are the kind of questions or problems we'll be solving. There will be a description. Most of the time there will be a description given of the problem. Through that description, you have to identify what are the relevant variables needed for me to solve a particular problem, right? And sometimes that's where the language game comes into the picture. You will be given some unnecessary information, some extra information which you may not need, things like that, and therefore you have to be very careful in terms of understanding what you even need to calculate the answer, right? So this is pretty simple. So $1,000 becomes $300 interest. So the total amount which the A will be getting back is the P plus I, which is P into 1 plus IN. In this case, that will become $1,300, right? Any confusion in this simple example? So back calculation kind of a question. Calculate the amount deposited 2 years ago to have $1,000 now at an interest rate of 5% per year. Can you do this? Can you try using this formula in your calculations and all? By the way, try to bring your laptops in the class if you can, at least with 1 hour charging port. I am not having enough charging ports here, but we'll be using a lot of Excel formulas, and it's better to keep them in your practice because NSEMs you might need it. So 2 years ago the amount was deposited. Now the amount is $1,000 at an interest rate of 5% per year. What do you think was the principal amount? Exactly. This is the most common mistake you will make in your Excel sheet. 5% versus 0.05. What you have to write? You have to be very careful. Your answers will differ significantly and you will get 0 marks if you do these mistakes. Okay. So this course is not about being the smartest of the person. It is about practicing and avoiding a lot of these mistakes. And this is a lot of BTech guys are trained in JE mindset. So it tries to close the loop of the 4 years that you have been prepared for. And yeah, but you will have to practice using hand as well as the Excel based calculations, because a lot of calculation mistakes you will get in this particular course. Okay. Does this need explanation, or this is okay? You got the final correction. Now, coming to the little bit more complicated and the most complicated concept of this course is the compound interest. Okay. So compound interest, as some of you had pointed out earlier, it is the interest, basically it's different from simple interest in a way that the interest also accumulates more interest if it is invested for another year, right? So the formal definition is the compounded interest is computed by applying the interest rate to the remaining unpaid principal plus the accumulated interest. In a sense, the interest also earns interest. I'll give you a very simple example. So this is another notation we will be using commonly. This kind of a subscript we will be using a lot of time. What it means is the end of year, right? So for example, if I'm starting my analysis at time equals to 0, this is capital P, or to make it very explicit, I can also write it P0, P0, right? Similarly, at each point of time, if I want to denote the money, you can use this subscript. So that is a very common notation we will be using. So what is happening here? At time equals to 0, you invested 1000 rupees. Let's say your interest rate was 10% per year. In year 1, the amount of interest that you accumulated was principal multiplied by the interest rate into the time period, which is for 1 year it got invested, right? So you got 100 rupees. So the principal at the end of year 1, how much it becomes? The original principal plus the interest accumulated. So that is 1000 plus the another 100 that you got for interest, right? Now, because it's a cumulative interest rate or a compound interest rate, this total amount will be considered invested for the next year. So in the next year, your principal becomes 1100, the same interest rate of 10%, the same period of 1 year, it gives you 110 rupees as the interest earned. So the principal at the end of year 2 becomes what? 1000 plus 110. So 1100 plus 110. So that becomes, what is that value? 1210. Now this amount gets invested for another 0.1, like 10% a year, 1 year, you get another 121. So the total amount at the end of year 3 becomes 1331, which is around 31 rupees extra compared to the when you have only simple interest in your mind. So that's where the interest is getting you more and more interest, right? So that's the kind of concept that is already visible here. This calculation is clear? 100%? First quiz, first assignment, everyone will get full out of full? Let's see. I'll plot the curve here. So I'm just generalizing the same formula that we tried to derive earlier. Essentially, let's say if P0 is whatever the value, your P at the end of year 1 becomes P0 into 1 plus I. I is your interest rate in percentage, or in here it will be in fraction, right? It will be like, for example, 0.1, which is the 10% per year. So that is the I here. And end of year 2, if you do the calculation again, it's essentially P2 is equals to P1 into 1 plus I. Now P1 is again P0 into 1 plus I. So you just replace this P1 by this P0 in this particular value. The P2 is equals to P0 into 1 plus I into 1 plus I. Making sense? So P2 becomes P0 into 1 plus I to the power 2. Okay? Why? That's why the convention is very important. It keeps you aligned. If you know P2, this particular, the generalized formula is P at the end of year n is the original principal amount multiplied by 1 plus I to the power n is the number of year that you have used, right? So yes, very simple, very childish thing that I am teaching you, I know. Extremely important when you are doing this calculation for long period, handling multiple cash flows, especially in Excel sheet. Because on your paper, you can draw cash flow series. In Excel, most of the time your cash flow series is in your mind, or you are trying to convert a cash flow series you made on paper to the Excel sheet. All these mistakes will happen. I am telling you for now, start, therefore, just go along with me when I am introducing some of the Excel components. It's only about which cell did you use for calculation, it can shift your entire answer by a significant margin, right? So all these, therefore these conventions are important. So your generalized formula becomes Pn is equals to P into 1 plus I to the power n. Okay, so far with me? Any questions at this stage? Too simple? Done? Alright. So then again, just a basic idea, what are the factors that affect interest rate for your knowledge? Again, this is not going to be an economics course in that sense, that econometrics or economics people are actually worried about a lot of these concepts. How much the interest rate will really be, what are the RBI policy that governs and so forth. And in real calculations that you will do, even for your projects, you might have to estimate the interest rate also. And that is very complicated calculation in general. So definitely you usually try to borrow it from some other standardized resources, or you try to see what other projects of the similar nature have tried to use the interest rate and all. Otherwise, it's a very macroeconomics detailed core subject, which RBI keeps on doing every quarter. They try to release their interest rate projections and so on and so forth. So you don't have to do the calculations again and again. You can actually use those values in your real projects. But for this course, most of the time, I'll be giving you the interest rate value, or I will be giving you sufficient information for you to estimate those values. Okay? But just an idea, ultimately the interest rate is governed by the supply of the money in the market versus the demand of the money in the market. So when you're talking about inflation and deflation, all of these concepts are basically a disbalance between supply and demand. Either supply is way high or demand is way low. That's where the disbalance starts happening, right? Alright, then just trying to repeat some of the common notations that we'll be using throughout. So capital P is the original amount or the amount of money at a time designated at the present time. So see, this is one thing that you also have to consider. In this course, or in this, whenever you are doing the calculation, you are dealing years as 0, 1, 2, 3 in terms of the number of periods. But the real years are 2023, 2024, 2025. So you can choose a point in time which you will call as 0, which you will call as starting point of your analysis, right? That is something that you denote as 0. Whatever is that, so you are basically creating a local frame of reference compared to the global. So you avoid the 2023, 24 notations and all, because I was actually confused by this one thing. In Thailand, they follow Vikram Samvat year. India should have this, but in Thailand they follow that. So their years are some 1,000 years apart from us right now. They have some 2,746 or something. And one of my seniors presented an economic analysis where the P value was like 2,746. I'm like, what is this random value coming out? So to avoid all those confusions, because people have different time scales in their local regional world what they want to use, to make it standardized, we follow these notation. You fix a time in your analysis, you call that as time 0. Everything happens relative to that, right? It could be that your problem is starting for total duration of the project is, let's say, 10 years. You could say time 0 is when the project is starting. You could also say time 0 equals to project when it's in the middle of the project. So then you have to deal with P minus 5 to P plus 5 kind of a notation, right? So it's a relative time that you fix, depending upon the problem. And later in the course, you will realize I will also be using these terms called present worth, present value. These will be typically in rupees or dollar or money unit. That we will also denote using P, capital P. Okay. Capital F is something that we use for future, which is essentially a sum of the P plus the interest that has accumulated over the time difference between F and P, right? And again, we'll be using this for denoting future worth as well as future value in many cases, right? Again, once you fix your P, the F gets fixed automatically, right? Or you can't change the relatively the time difference. You just have to fix one time reference and then everything keeps moving accordingly. A is also a common term, capital A. It's essentially a series of consecutive equal end of period amounts of money. In a simplistic term, let's say you borrowed a car loan of 5 lakh rupees for whatever the interest rate is. Typically, you are expected to pay an equal amount in your installment every month. That installment is a very good example of what we denote as A. So it is basically you are paying every time period and the exact same amount you are paying throughout. So it's a very special type of time flow series as we call. So consecutive, equal, end of period I will come later. But essentially equal amount paid at an equal time interval, that is denoted over the amount A, capital A. Okay? Easiest way to return is you return your loans. Typically you return your loans by, okay, in Hindi we call that term as kisht. I don't know in English the term installment is there, but installment does not have the same feeling as kisht, so that is the term that I want to use, right? Then N is the number of periods. The number of periods can be part of years, months, days, depending upon what is your analysis requiring, right? Currently, do you think in India, the banking interest rates, how are they defined? Are they defined on a daily basis, on a yearly basis, on a monthly basis, quarterly basis? Daily basis. Now even your banking systems, every interest, because of the computer, now you have a lot of computation power, so every day interest gets computed. Yes, on paper you will be given an equivalent rate, okay, per year we will be given 2.5% interest rate, but that will be changed to a daily interest rate. How? We will see later, but that's how the actual calculation happens at the back of the mind, right? Because when the transactions are huge, you can imagine at a country level, at an RBI level, or even an SBI, the whole SBI level, you are talking about crores, some 10,000 or some 10 lakh crores rupees or something. So many zeros that the interest rate zeros gets marginalized, and that huge amount, the variation within a day becomes important. That money is quite significant. So therefore, that has a huge implication. Stock prices, even minute basis, they keep on changing. So depending upon what is your time scale analysis, you can actually keep on changing this. Fundamentals remains the same. I is the small I is the interest rate per interest period. So if we are defining interest periods in whatever units, years, months, days, the I, ultimately you have to use the I which is equivalent to that number of that same period unit, right? Typically used in percentage form, given in percentage form. In most of the calculation, it is used in the decimal form. So don't forget that. And your entire course will be centered around that. Out of these, you will be given 3 parameters so that you can estimate the 4th parameter. That's your whole course in a nutshell, right? Becomes complicated, but that's your whole course. If everything else is given, you are trying to estimate perhaps I. If I, N and P is given, perhaps you are trying to estimate F. If F is given, I is given, N is given, perhaps you are trying to estimate P, and so on and so forth. All the combination variations of that, the same problem will come to you. Alright, any questions so far? Do you notice these concepts in your daily life? Do you use these concepts in your daily life? Where? Where? Do not use. That's a good answer. No need to use, so then yeah, I can't ask more questions about it. Okay, so if you, that's also part of the course in terms of at least in examples, we can cover those. While I am giving you a lot of examples which are machinery and equipment or construction related, if you think there is an example worthy of your daily to day-to-day life decision making, bring it up, we will discuss that in the class. It's same principle, we can still solve it, okay. So, this is the very important term, something called a cash flow and a cash flow diagram. We denote cash flow diagram is basically diagram representing cash flows. So, cash flow occurs whenever cash, which is the real hard money, of or equivalent what you consider as valuable, flows from one party to another, okay. So, typically in a transaction there are 2 parties, someone who is giving the money, someone who is receiving the money. So, when transaction occurs only when there is a cash goes from one party to another party, okay, and that is something called a flow because the money is flowing from one hand to another hand. So, cash flow in, cash comes in when you receive the money, cash goes out when you pay the money, right? Simple. At any point of time, your net cash flow is the amount that you received minus the amount that you paid. right? We call something as end of period convention, and we use this convention very often in this particular course. The idea is, for example, if you are having an interest rate on a monthly basis, can you imagine on a construction site that all your cash transaction or within a month there will be no transaction? Can it happen? You will be typically doing transaction on a much more frequent basis compared to the rate period that you have estimated, right? So whatever happens in between two periods, you try to shift it towards the end. The net of it you consider at the end of a time. For example, all the transactions that are happening between period 1 and 2, month 1 and 2, you use the equivalent of all those sums and shift that, assume that everything is happening at the last day of month 1 or month 2, whatever, right? So that is called end of period convention, okay? Similarly, there could be a beginning of period convention, and how does it changes the outcome, we will discuss. Is it clear? The end of period convention, because of your unit of analysis that you set for whatever reasons, all the transactions that are happening in the intermediate time period, all of them are shifted towards one end point, and you do only calculation only at that end point. Make sense? No? I'll give you more examples as we move along, but you could also imagine, for example, banks. In a daily basis, they have millions of rupees getting out, getting in. But at the end of the day, they release a statement. Today, net money came to the account this much, net money flowed out of the account this much. So the net money bank received at the end of the day is this one. You report only that number because that makes the life easier for everyone. Idea is that the small window of period that you are not considering, that is not having huge effect on your analysis, because time is a continuous matter for that. Ultimately, you are making it in a discrete events. So you are assuming that whatever is happening in between that period is not significant effect to change the outcome of your analysis. But in certain situation, that assumption can be questioned, and therefore you can also have your own later conventions. In this course will be by default, if there is nothing mentioned in the question, by default it is the end of life convention, end of period convention that we are going to use. Okay? By default, if nothing is mentioned in the question, it is end of period. If nothing is mentioned and you come to me that I assumed it is an start of period convention, I will also assume that you get 0 marks. Simple. Okay? This is an assumption we follow, and we follow it to the core. Unless and unless specified that you have to do problem in certain manner, and we will do. I'll give you the sufficient examples to make you understand what this convention is. Alright? An example is shown here. So typically your cash flow diagram is essentially such kind of a diagram. There are two axes. On the horizontal axis you have a time, equal intervals. You divide the time into equal discrete intervals, and if there is a net positive flow, you typically plot in on the positive side, and the length of the arrow is proportional to the amount that you have. For example, if it is 100 rupees, if the same transaction would have been 200 rupees, perhaps you would have had a straight twice the size arrow, not like a arrow that I have drawn, but essentially that's the thing. And if the money is going out of, you show it on the negative side. Right? Make sense? Again, this convention can be changed. In your particular problem, you could be interested that no, I will show positive on the below side but negative on the upper side. As long as you are consistent within solving the same problem, you are not changing the convention within the same problem, you will get the same answers. But if you change the convention in between, you will get very awkward answers and very awkward marks, right? And that will happen precisely because a lot of time the formulas that you use are derived using this standard convention, where you consider the positive on the top side, the negative on the bottom side. But question forces you to sometime takes a different kind of an approach, and in those cases when you are using the formulas directly, it becomes complicated. Also in Excel sheet, the convention is just the opposite. So in Excel sheet, if you do the calculation in the same manner, Excel will give you a same number but with a negative sign. So you have to interpret that negative sign with a very careful eye, right? So have a consistent frame of reference in terms of time, in terms of the convention of cash flow direction, which direction you are considering positive, which direction you are considering negative, throughout one specific problem. Keep it consistent. Okay? Any question here? Alright, so let's plot a cash flow diagram. So this is what you will typically get in the questions. So a rental company spent $2,500 on a new air compressor 7 years ago. The annual rental income from the compressor has been $750. The $100 spent on maintenance for the first year has increased each year by $25. The company plans to sell the compressor at the end of the next year for $150. Construct the cash flow diagram from the company's perspective and indicate where the present worth is located. Read it again. Got it? Understood? So now look at the table here. Again, this is an example that I am trying to show it to you. You can later do on your own. So first is to identify where is the present worth even located, right? So you see on this table, it is, I am setting it here because we are talking about 7 years ago. We are talking about 1 year in future. So right now, this is the kind of point that is naturally being given in this particular problem, right? So I am setting my time 0 at this time. So I have to start plotting the transaction that started occurring 7 years ago, right? What was occurring? The rental income from the compressor was $750. Again, you are using the end of period convention. So this first 750 is shown at the end of period -7 to -6 at that boundary, not at the starting of the period -7. Got the idea? Because before, if you would have put the money there, it means even before you bought the air compressor, it was generating money, which is impossible for it to happen. So therefore, this is the end of period convention example. Then every time you are spending $100 on maintenance in the first year. So $100 in the maintenance in the first year, and that has increased by $25 each year. So you see there is a series in this. At the end of first year, this was $100. End of second year, it became $125, $150, $170, and so on and so forth. Making sense? Right? In the beginning, there is a cost to acquire the machinery, which is how much? Because it's given, right? The company spent $2,500 in order to acquire that money. Now net cash flows. So cost you can keep in the convention that we have followed. Cost goes as a negative side, income goes on the positive side. So your net cash flow is minus 2,500 in the year -7, because that's happening at the beginning of period -7, right? You have to take account into that. Then the net difference is the income remains same, basically $750 throughout the year. Only when you are selling the compressor at the end of the next year, you generate additional 150 rupees, right? So this 750 terms denote the money that you got by operating the air compressor for the next year, and then you sold it at the end of the next year, so you still got another 150, and that's why it's coming on. Okay, very simplistic. I am making it sound. When you will do it, you will always have this tendency where this edge is and where the money will actually go. You will try to put it on another second year, or you will try to put it in a year 0th. You have to pay attention to the logic given in the question. Okay. Now the net cash flow is basically subtraction of the income column, no, cost column from the income column, right? So this is net is 650, 625, 600, 575, 550, 525, 500, and 625. Okay. Making sense? Now that you have the year information and you have the information on the net cash flow, your cash flow diagram is ready. All you need to do is convert the same diagram into a arrow based representation, because when I'm asking you a cash flow diagram, this is the diagram, that is just a table. Ultimately you have to convert here, right? So at the end of year -7, there is a 2,500 cost, then everything is income, so it's shown as 650, 625, there is a linear decline, and then finally at the end of year 1 you are getting amount 625. Making sense? Now imagine, like instead of a compressor kind of a question that we dealt with, suppose this was a diagram of a person who lent money. So at the end of year, 7 years ago, I lent you $2,500. I've been getting these much money in terms of whatever. How would the cash flow of a borrower would look like? Yeah, essentially your axis will be reversed in this case. So the entire things basically flips. So your borrower will have a $2,500 income 7 years ago. Then he has to pay some amount in a linear way and some other amount in a at the end of that, right? So this is also an important principle. Again, we will be using it later in terms of accounting. The borrower, the net sum of the borrower and the receiver has to match, like it has to be 0. Otherwise, there is extra money being created in the system, which is not allowed. Money remains conserved, right? Alright, so this is here we will stop today. We'll start with the economic equivalence concept. Any questions so far? Pretty easy.